We're going to look at Meta in 2022. Another fantastic example of the 10K revealing your actual returns and showing how de-risked Meta really was in 2022. If more investors actually looked at the 10K instead of the market, instead of the news, the panic and stock tickers, they would have so much more conviction. What is the ROI of conviction? You can't really measure it because it could be infinite. And that's what I'm going to talk about, because really people say, I don't really know, you don't really know where the bottom is, you don't really know how to measure the returns. I'm going to talk about that because this is really the most important part of investing. Your entry valuation is so important because it tells you if you've got a margin of safety or not. I get a comment in some of my videos. I get comments all the time criticising, and I do enjoy it. Listen, this is the game of finance. Everyone has their own opinion. It's not physics where it's just a set law. And I'll be honest, I read the comments, I look at them, and I'm always open-minded. I'm always open-minded to learn. If I'm ever wrong, I want to know the correct answer. But I've just yet to see something that really makes me think differently. Because the financial performance of a company dictates the stock market return. And that's what I'm going to talk about. I think the comment said, valuation doesn't matter because it's only relevant if you're investing for more than 2 years. And I thought, okay, obviously, well, if you said valuation doesn't matter between buying a stock today and selling it next month, of course valuation doesn't matter, because it's the stock market sentiment and narrative and liquidity, and these are all things you can't control. What you can control, though, is looking at the financials to make a decision. Is this company going to compound? If you invested in Meta 2022 after reading the 10K report, your compounded annual growth rate would be 10.2% if Meta stayed flat or even declined. Because we use enterprise value with owner's earnings. And this is things Wall Street don't really use. They don't use owner's earnings, they use free cash flow. They don't really use enterprise value, they use market cap. But if you looked at that and said, 10% return, the downside is capped. The risk is, it's de-risked to a massive degree. That's why your entry valuation matters so much, because someone who overpays for the same asset doesn't have that yield, whereas you would if you did invest in 2022. Listen, I didn't know this information in 2022. I wish I did. I wasn't educated to this degree, but this is going to be so much of an ROI in the future because there are opportunities and similar case studies are arriving today. Okay, so this is all from the 10K. Market cap was 314 billion. Now, when you buy a company, you also buy its cash and its debt. And this is something else to consider. If a company's cash position goes up every quarter, every year, and its debt's going down, that is creating a more attractive enterprise value. So keep it simple. Just deduct the cash, the net cash, from the market cap. That's where I got my enterprise value of 283 billion. And I'll show you where I got my owner's earnings from. Owner's earnings is the Warren Buffett textbook definition. Because what Warren Buffett says is, look, if a company's discretionary spending money is free cash flow on a new investment, like Mark Zuckerberg decided just to light money on fire back in 2022, but it was optional, it was discretionary, it wasn't mandatory to maintain the company, to keep revenue alive. So what we do is we deduct maintenance capex. And it's just every single business has maintenance capex. How much does it cost to keep revenue alive? So if it's a truck company, we need to repair the trucks every year, so we need to set money aside. But growth capex is optional, discretionary. Build a data center, invest in new infrastructure. So what I do is we look at this cash flow statement, and we see property. Purchases of property, plant, and equipment is there, 31 billion. That's not the cost to maintain the business. That was just Mark Zuckerberg saying, I want to build reality labs or whatever it was he was investing in. However, look at this. This is really important. Net income. You'll notice this a lot with big tech. The net income, 23 billion. Actual cash that landed in the bank was 50 billion. So Wall Street looked at the net income and said, it's declined by like 40%. Immediate panic and chaos. Whereas owners said, well, let's have a look. What about the actual cash? It's actually shown as the actual cash is more resilient because of all, you've got to add these items back. Yeah. So what I do is I'll take the operating cash flow, I'll deduct stock-based compensation, financial lease payments, and we'll deduct maintenance capex. That's the Warren Buffett method, and that's owner's earnings. It came to 28 billion. If Meta it stagnated for the next 10 years, minus 2% every year decline. As an investor, you would get 10.2%. So it's already beaten your hurdle rate because it needs to beat 10%. This is showing the example of it stagnating. But the whole point is, the asset is de-risked. It's de-risked. Now keep in mind, if your enterprise yield was like half of this, say the enterprise value was 5%, for you to get the 10%, Meta would have had this, and if I change that number to 5 yield, it needs to grow revenue by 5% every year to get your 10%. So in this example, it already beat the hurdle rate. But right now, if you're looking at like a big tech or a company, and your enterprise value yield is like already at 5%, the company doesn't actually need to do that much work to achieve at least your baseline hurdle. And of course, this doesn't include buybacks. If the stock price stayed flat for 10 years, the company would buy back its own shares as well. 40 billion in cash. So 40 billion in liquid cash, 9 billion in debt. So first of all, the risk of insolvency was literally zero. Often companies, like some companies, it could be a dying company, might have a very high enterprise yield. But that's why you need to actually look at the cash to check that it isn't like a trap. But look, it had 40 billion of cash. It still had, 2 billion people using the platform. So de-risked. And what the point of this video is it's showing you what you're actually getting here is a free call option. This is a call option on the future, because any new innovation, any new margin expansion, even just a new app, and Meta did create a new app, Threads. So Threads was a competitor to Twitter. How much does it cost Meta to set up a software app? There's not any major cost, but it keeps users on the platform for longer. It increases screen time, which increases ad revenue, and that's a call. You're getting that for nothing. When you invest, if you invested at this point, any future innovation you are getting for free in this scenario. So it's call option, free call option. However, see, if we say like it was to stagnate for 10 years, what we're really doing is we're using like a traditional discounted cash flow model. See, all these financial models were made in like the 1950s, and they were designed for old infrastructure companies and factories and old businesses. But there isn't really an accurate model for the modern era, because we live in a digital economy now where these companies don't grow linearly, they grow exponentially. So even just a 5% improvement in ad targeting goes straight to the bottom line, taking out even just a little bit of margin expansion. So he took out like 10% of the staff with ad target improvements. And what really happened was the business actually paid back in 36 months the original investment. The enterprise value was paid back. So 98% cash generation of your entry in the enterprise value. You see, because big tech companies grow, their growth is so explosive. even with a bad entry, the growth actually acts as a protection. So once the investor has recouped their entire purchase price in cash within 36 months, the probability of permanent capital loss drops to zero. All future cash compounds is absolute profit. So this is a margin of safety. So when I see an investor with a margin of safety on a stock, a lot of investors did get in early to some of the big names. Lots of investors got into early in companies like Palantir, Nvidia, Google, Amazon, Microsoft. And what I'm trying to say on the channel is you have a margin of safety. So you got in early enough, depending on when you got in, you have a margin of safety. And you will never, if you sell that stock, you will never get the time back. So it's lost forever. Yeah. Just again, another example of how asymmetric the investment decision was. If Meta was to grow at 5% a year, just the revenue, 5% a year, the compounded rate of return up to 18%. So just to put it into perspective, you read the 10K, it's 2022, we look at the 10K, we look at the financials, and we say, do we believe Meta can grow at revenue at 5% for 10 years? If we believe it, the calculations showing we would outperform the market. Yeah, we would outperform the market, we would outperform the NASDAQ with 18%. But in reality, what actually happened was, it compounded like 75% because of Mark Zuckerberg pulled every lever you can pull. And the stock exploded. The financials prove they control the stock price. The numbers control it. It's almost as if Mark Zuckerberg can turn the dial if he wants the stock price to go back up, cut staff, cut costs, cut capex, and the stock price can just explode upwards. It's not linear. The big tech companies are not like this. Another major point I want to talk about is whenever you see an announcement to like a big tech company and it says like, okay, we are generating 10 billion from a new product or a new business opportunity. Amazon ads is the example I'm going to use in this video. Amazon ads, for example, 10 billion. What a lot of investors do is they'll look at the revenue and say, that doesn't even move the needle. So if a business has got 200 billion coming in and okay, they get an extra 10 billion, that doesn't really mean much to me as an investor, but it makes a huge difference. It does make a huge difference because it would push your yield up. In this example, it would push the yield up by like 58 base points, 0.58% on your yield, which then means the companies needs to grow revenue even less. It's even more manageable. There's a less economic burden on the company. Yeah. So in this example, what I was using was, imagine you entered your position at 5% yield. So the company needs to grow revenue by 5% every single year. Let's say it rents out compute to Anthropic, 10 billion deal. That immediately adds it adds 150 billion to the enterprise value, and it reduces the burden of the company. So now the company only needs to increase its revenue by 4.8% every year, and for hyperscalers, that's very achievable. Very achievable. Amazon's the textbook playbook for this. Before advertisement, it was doing like 540 billion. So let's say your enterprise value entry yield was 2.5%. Well, because ads are pure software, just throwing advertisements on its existing platform, a lot of that was just pure profit. 80% margin, after tax 37 billion, cash swells up, and $800 billion added to the enterprise value for Amazon because of its ad campaign. Do you see what happened there? Is it moved the entry, the yield, your enterprise yield went to 5.58%. Yeah, so it is constantly reducing the requirement, the burden of the business. this is what I'm saying. Like, if you're looking at the financials, it does change your complete perspective. Even just looking at the 10K, looking at the report, you start to have a different perspective. Coming away from the stock ticker and looking at the financials. Yeah, it's so vital. It's so important. Now, in the example I was just using there, this was for Meta, obviously, but you don't even need to have the valuation entry absolutely perfect if it's just at least fair, because these companies have such a strong ability to actually grow their cash flow. It can protect an entry valuation the longer you actually hold in the stock and hold in the share. So what I'm saying is, even if you see any potential for new revenue streams from AI, from cloud, any other potential options there is there, you can see the upside is dramatic. But what I do believe, we're going to see very fair valuations, especially next year when capex is going up and higher. Some of the biggest tech monopolies on earth, the valuations could become more and more attractive. And this is the sort of valuations we want to look out for. And you can see, for me anyway, it completely changes my view on an investment. When I see those sort of yields, you start to look at it from a different perspective. You're answering a different question. You're answering the question of, can this company increase its revenue by 5% every year for 10 years? And it's like, that's not really a huge hurdle. That's very small, considering these companies are, look at the actual growth trajectory. If you even just look at the past couple of years for some of these companies, the trajectory is immense. And even for other investors who I did say, obviously, in my last video for Apple, it doesn't really work for cyclical companies, but it depends on how early that investor got into the company. So even like for example, Nvidia, if someone got in early enough to Nvidia and there was a trough in the future, like say 2029, 2030, the digestion phase sets in for the hyperscalers and they reduce their spend because demand is satisfied. If the investor was in early enough, they still have a margin of safety, even for a cyclical company. But the same can't be said for someone who just buys it at the top or whatever. So the argument that valuation doesn't matter is the most ridiculous argument I've ever seen, because it's the only real chance that investors actually have. It's so vitally important. It's so important. That's why this information, I think, is important. And it's just totally should change your view and trajectory on investing. So there you have it. More opportunities coming. I'm enjoying doing these valuation checks because it really does open your eyes to calculating your actual returns. And for my ETF investors, similar calculations can be done. It's a bit more difficult and more complicated depending on how broad your ETF is. But the same rule does apply, that your margin of safety will grow over time, even with an ETF. And that's why it's so important to really stay in the market and stay in your investments and detach from the stock ticker and detach from the volatility.